Everyone, welcome in for the first time, Dividend Degenerates. I gotta say, I love the name because I'm kind of degenerate myself. Where did you come up with that?
Seeing these high yield funds late 2024 and was watching a bunch of YouTubers and they kept saying the word degenerate. This is a degenerate play, high risk play. So, um, and I wanted to start a YouTube because no one was covering all of the high yield funds all at the same time. Some it was yield max, or some do this and that, some do options, degenerate option plays, and I wanted it all in one. And typically, they're not dividends with these high yield funds or distributions, but distribution degenerates just didn't sound right.
Mm.
So dividend degenerates, and it wasn't taken. There is a YouTuber dividend degenerate with like 2 subscribers, so I figured there's no competition there. So here we are.
No, that's cool. And how did you get into this space? Like, what's your background?
Um,
Are you like
I
an accountant, an engineer? That seems to be like the general thesis.
well, my education is finance.
Oh, okay.
Out of college, I was a stockbroker, and I saw the dark side of being a broker. And this is in the early 90s. So here's a phone book, start calling people, which I didn't mind. I knew that's what you had to do. And there are a couple of years, that is now a defunct broker. And they got into some trouble after I left. Then I went back to school,
Was
got
it
a,
Stratton Oakmont by chance?
what's that?
Was it Stratton Oakmont by chance?
It was not. I guess I can say it. It was Chatfield Dean.
Never heard of it.
Yeah, it was not a big firm. It was, and I actually loved it. But my favorite movie at the time was Wall Street, Charlie Sheen, Michael Douglas. And I got a huge account for back then. It was like 50 grand out of the phone book.
Wow.
My supervisor took it. He said he was going to take care of that account. Keep calling, keep cold calling. So I wasn't happy about that. And after a little while, I left because I wasn't making, you get a base salary, it was a couple $100 a week plus commissions, but I wasn't getting super commissions because they were taking all the big accounts. And so I ended up leaving. Uh, and then I got into healthcare. I sold insurance. I got all my insurance license, my Series 7, all that stuff. Sold insurance for a while, several years. And then Obamacare showed up, and I got laid off like the day he was elected
Mhm.
because Obamacare was going to change everything, which it kind of did, kind of didn't. So then I started working in healthcare, and right now I work in urology, and the pay is great. I'm paid like a PA, but I'm not a PA, and I'll do this till I retire, hopefully 3 to 5 years.
Cool. Now, how'd you get into the whole dividend space? Like, you went from a stockbroker. There doesn't really seem to be a natural progression going into, or maybe it does.
No, I mean, after I left that firm and started getting into insurance, I didn't own anything. I was doing the life insurance exchanges and getting people, helping people do that. And but then I don't know, 5 or 6 years ago, I was starting to think about retirement. I was in my mid 40s. I'm 51 now, and I found VU, which is kind of the gold standard of dividend investing, and it did well. But it wasn't. I mean, I'd have to be in it 30 more years, and I don't want to retire in my 70s. And I was putting a little bit in every week, but just wasn't keeping up. And in one year, it was actually down, even with the dividends. And that's when I said I got to find something better. And I found the first one I found was IWMY from Defiance. That's a Russell covered call fund. That's been good. Total return's good. It's an index. And so then I started thinking a little higher yield. Let's see what happens. So then I dove in with a bunch of the single stock ETFs, either covered calls or some do put credit spreads. And The yields are great. Total return is not. But I look at it as these are long-term holds, maybe lifetime holds. If it pays 100% yield and it goes down 90%, as long as it doesn't go to zero and it keeps paying, I'm okay with it. It's an income play. Totally no growth, income.
Yeah.
So that's where I'm at.
So what do you like the covered call funds, or do you like to put credit spreads? We can kind of get into the nuances of what makes them different.
Yeah, I mean, they're different. It depends on the underlying, of course. And I mean, covered calls, you're capped on the upside and you don't have downside protection. The put credit spreads, you're totally capped on the upside, but you do have the downside protection. And then some of them are doing collars and, iron butterflies. And, those are making massive income, but you're totally capped up and down. So, I mean, they're all different. It's hard to say what's good or not. Depends on what the market does, which we can't predict. So that's why I own, I don't know, I think 25 option ETFs, and then just some regular non-income ETFs. I do own the Tuttle one on Europe Aerospace and Defense. That's been great. I own the DRNZ, the drones fund from Rex, which has been good because I think 2026 is kind of going to go into. I mean, I know AI is going to still be a big factor, but is it going to be just the AI infrastructure? Is it going to be? I know Matt Tuttle was talking about Palantir being the nervous system of AI, which is, I think that's still a good play. It's just hard to say what's going to make money in AI in 2026 because they're dumping a ton of money in and not really making any revenue from that yet.
Yeah.
So it's hard to say.
Yeah, most of the GDP that we've encountered in 2025, it's like 3% of total GDP was made up of AI, which has zero revenues.
Yeah.
So, like, if we didn't have the AI play this year, we would be in a recession, basically.
Yeah. And will that continue? It's hard to say. I mean, they need to start showing revenues from it.
I mean, this kind of reminds me of Boiler Room, like the movie.
Yes, another favorite of mine.
I know, me too. That's how I got introduced to the market, was Boiler Room. And it kind of reminds me of that, where they're like NVIDIA is just, they're saying, hey, we generate so much revenue and we're going to buy OpenAI and we're going to buy AMD and we're going to buy this. And then AMD's saying, well, we're also buying, it's like just a circle. They're just pushing the wheel.
Yeah.
Until they make something, I guess. I don't really know how if it's free, I don't know how they generate revenue.
They make a ton of money, but they're also spending a ton of money on other things that aren't showing revenues yet. And they can do that, which is fine. But, a lot of there's so many AI plays and some are just not gonna work.
Mm-hmm.
And it's hard to predict what will and what won't. There's just so many, is it power? Is it cooling or both? Or, infrastructure, data centers? I know data centers in space has been talked about. I mean, that would solve the cooling problem, but then I hear you need you need to heat it. So who knows? It's going to be a great year though, either way.
I was recently on with Louis Navalier, like billionaire hedge fund manager, and we had a very similar conversation. And he was saying, like, the data centers are going to get built because obviously energy is a big issue in this country, but it's not necessarily the energy we produce; it's actually the natural resistant, which is heat loss. And one of the ways around that would be like New York and Chicago are the only two major U.S. cities that currently run nitrogen through. They have superconducting lines that come down from, like, people in New York probably don't know this, but they get most of their power generation from Canada, and it comes right down. But they use superconducting lines and they put nitrogen through the line to keep it at like a sub-zero temperature. Now, nitrogen is one of the most ambient natural gases that we have in the atmosphere. So that's perfect. Chicago also uses it. There's a couple key countries that I don't want to mention because they will get flagged on social media that also use it, and they are just kicking our butt in electrical use. I think that's probably the way it goes. But simultaneously, which I brought up to Lewis, was you have to have both being built out. You have to have the data centers to build out and the infrastructure. You can't have one without the other because we generate so much excess electricity that if we were to just make America super efficient, we're going to have to start shutting down nuclear reactors because we overproduce in the spring and fall. So we need the data centers to throttle the electricity back and forth. You know, we're making too much power. Let's ramp it up and mine Bitcoin or AI or whatever it is in the spring and fall months. So that's kind of where I see is like everything has to kind of, you know, in perpendicular motion has to be built out.
That makes sense.
What do you think of precious metals? We got. I had to make a list because like everything went crazy this past week. Silver, gold, platinum, all hitting all-time highs. Platinum was up 11% yesterday, 55% for the month. Copper's up 11% for the month. Silver's up 40% for the month. Gold's up 7%. Palladium's up 38%. Lithium, which is the battery storage because we need batteries, is up 33% for the month. What do you think?
They've been slow for so long, so they were due for a run. I did not anticipate a run like this, especially with silver. So I think we'll see some sort of correction in precious metals. Will it be next week, next year? I don't know. It's just going up so high so fast. I do own a covered call fund on silver from Curve, KSLV, KSILV. That's been great. And I don't have any gold exposure, and certainly I want to get in on that. But is it too high? Am I getting in at the top, or is this a midpoint? You know, it's just hard to say.
Gold, I don't really care for silver because we don't use it. It's too expensive. It's not a reserve currency in any country. Yeah. If I was to go into anything, I like physical commodities. I would be buying physical gold. I would be, and I own physical silver, platinum, and copper. Now, copper people throw away. Copper and brass people throw away at the dump. You can pick it up and you'd be up 1,000,000%.
It's worth money, yeah, for sure.
Throw it away. But gold specifically, I think it's just going to keep running. I mean, it's kept pace with housing for the past 100 years, like 6-8% a year. But more importantly, the international bank that takes care of all of the Federal Reserves across the entire global. No one knows who this guy is, but he kind of reminds me of I don't know if it's the show called Dinosaurs back in like the 80s, and they had this dad, this like big dinosaur guy, and he kind of looks like that, but no one actually knows what this guy's name is. They don't remember because everyone thinks Jerome Powell. But he basically tells all the Federal Reserves what to do. It's in Basel, Switzerland. And they moved gold from a tier 3 asset, which is like risky, physical gold, to a tier 1. So you remember, you know, pre-1978, where like gold was, we were on the gold standard. Now we have treasuries and physical gold being held by international banks as a tier 1 safety asset. So we have U.S. treasuries in gold, physical gold, not spot gold. So a lot of people trade the spot. Spot gold is still on tier 3. It's still being listed as a risky asset. Silver is not anywhere on there. But the physical gold, so I think that's what we're seeing is a lot of people going, countries, institutions buying up the physical gold supply. Where do you stand on oil?
I think oil is going to come down in 26. The whole year, I don't know. It's going to come down before it shoots up. Yeah. You know, with the drill baby drill hasn't really started yet. Once they start doing that, it's the price of oil will come down. How much? I don't know. I don't have any oil exposure, but if I see it really come down, I might, find an entry point there in something, whether it's an option fund or oil futures or whatever.
Yeah, I don't think personally I like Occidental Petroleum. I think that's probably my favorite to play. I bought it at 14 back in like 2021. It ran up to 70. I sold it, and I told everyone at the beginning of 2025. I said, oil's just gonna crash, like it is, and it is. It's way down. It's down like 50% right now. But yeah, to your point, I think it's gonna still come down. It has a lot of bleed.
Yep.
The price is just too high. Did you look at I don't know if you looked at the CPI that just was released for November. If you look at the total chart, oil was up at like 11%. Everything else is like 2-3%. Oil was super, super high. And I said, just get out of oil. Like it's too high. They have to crush it. They have to bring this down. People can't afford it. People just can't afford to pay the utilities anymore or their electric. Energy in total. Power grid stuff is just getting its face kicked in right now for commodity futures.
My home electric bill is I'm not happy with that for sure.
What part of the country are you in?
I'm just outside of Tampa, Florida.
Oh, okay.
And we use Tampa Electric Company.
And you guys have one of the lowest rates of electricity in the country.
Doesn't feel like it, but I know it's not. I know it's worse other places, and we don't need heating oil or anything like that. It's all electric. But yeah, I mean it's gone up every year for the last several years.
I want to say last time I looked, I think mine's 38 cents a kilowatt hour plus distribution, and now we're also paying. Like if we have to subsidize, because I live in Massachusetts, we subsidize people that can't afford to pay. Subsidize people want to put solar energy or something on their roof, or the wind farms. Like the federal government's leasing out Cape Cod Bay and Nantucket Sound out to. It's a Dutch company, and they lease out all the federal water, so they're putting up all these wind turbines. And of course, like the whales and stuff are hitting them and crashing and dying and landing up on shore. That people see
on the boats off, and yeah.
But we subsidize that as like we don't have a choice. They just send us the bill, and it's all subsidized.
Yeah, I'm not crazy about wind. I mean, it's just it's supposed to be clean energy. If you see how these things are built, it ain't clean at all. And then what it's doing to the whales and the fish and the birds, and then the power generated is, I mean, there's other cheaper, cleaner ways to do it. I mean, it looks clean because it looks like it's just wind, but it really isn't. You need motors and oil and all that. So I'm not crazy about wind.
I agree with you, and you're right. I have a friend that changes all of the synthetic oil and all of these things. So what it is I've never actually talked about this, but now that you brought it up, there's a generator at the bottom of the windmills. It's a diesel generator that has to, because these windmills are so big, they need something to start it turning. It's like a supercharger where it has like, it takes energy to make energy sort of thing. And the diesel generator has to get it moving, but it takes, I forget what it is. It's 100 gallons of synthetic oil that has to be changed out like once a month. So it's not profitable. It's not profitable. There's no way it's making energy.
Not enough to pay for itself.
No,
for sure. Yeah.
What is your favorite? I don't want to put you on the spot like that because that's not fair. If you had to name 5 of your favorite covered call ETFs, what are they?
Oh boy, well, I separate them into yield, just pure yield, annualized yield, and then total return. So, I mean, my biggest holdings are TSYY from Yield Boost. That's a Tesla put credit spread fund. Pays massive yield. My total return is up on that. and I've been reinvesting all the distributions. I don't take anything out. This is I'm not living off this. I'm just putting in a little bit of money every week from my paycheck, and then reinvesting those distributions, and it pays weekly. And I mean, my capital appreciation is down. My cost basis is higher than what it's worth now, but it's paid so massively that I'm actually up on it. If I sold it right now, I'd be up, I don't know, 50% annualized.
Mhm.
No plan on selling that one. I also own iCoin from Bitwise. That's a Coinbase covered call fund. They do a synthetic covered call, massive yield. Total return on that is down, but I don't plan on selling it. So keep paying. And they're monthly, but they're paying twice in December. Just worked out that way.
They're paying twice in December. Oh, they're synthetic?
Yeah, they do a synthetic on Coinbase.
Yeah, that's why they're paying on monthly. That's why they're paying on twice.
Yeah, because I think there were 5 weeks. I think they're every 4 weeks.
No, so this is actually a good point. And I'll bring it up afterwards. Finish what you were going to say for.
If you look at like their distribution calendar for 25 and 26, they declare once a month.
Okay.
There's no set. It's usually Thursdays they declare.
Sure.
It's not always 3 weeks or 4 weeks or 5 weeks later. It varies. I can't figure out that pattern. But because they declared Thanksgiving the day before Thanksgiving, normally it's Thursday, but it was Wednesday that week, they paid December 2nd, I believe, Tuesday. Then they just declared again this past Wednesday, Christmas Eve, so they'll pay the 30th, Tuesday. So 2 payments in December. And then I looked ahead, it's like 2 in March, 2 in September, and then 1 month they don't pay because it just works out that way. It's 12 payments a year.
Oh, okay. Interesting.
But it's not like like Yield Max, when they were monthly, they were every 4 weeks, not monthly.
Yeah.
So sometimes you get 2 payments in a month. But this is strictly monthly, 12 payments. With Yield Max, you got 13 when they were monthly.
Well, that makes sense, because if you were to actually take the overage of months, you'd actually have 13 months. I forget the first, like, what is it, Gregorian calendar or whatever, it actually had 13 months. It wasn't 12.
Right. Yeah. Some months have 5 weeks, some have 4.
Yeah.
And I think January's 5 weeks too.
Interesting. Okay.
5 Fridays.
First off, I just want to say thank you to Mike from Vista Shares. He sent me a nice hat. This thing is sick. So shout out to Mike. What I was going to tell you, though, is a lot of people, especially in December, get either they'll get a massive dividend payment or they'll get an extra dividend payment like you were talking about. And the reasoning for that, which I don't think a lot of people understand, is they're using synthetics. So because they generate so much in premiums, anything above, like, they have to pay out 90% of the premium. They can't just keep it or roll it over.
Yep.
And those are the funds that are using the synthetics, like Roundhill, for instance, will pay out usually massive premiums year end.
They paid a massive on their one of their index funds.
Yeah.
I mean, like 200. Normally, it's like 50% annualized yield. They paid like 200%.
Yep.
They declared the other day. So yeah.
And that's because it's synthetic. Now, if they were actually holding the underlier and trading options on it, they fall under 1256 contracts. And so, like T-SPY, I just had Sai on. They're able to roll the money back into the NAV. So they just keep it steady Eddie, 12%. You can just count on it like clockwork, and they can just roll the rest into the NAV. So you're always getting. T-SPY is actually one of the few covered call funds that's beating the underlier, which is surprising because most of them don't.
Sure.
So for your audience, that's a good thing to notate, is if they're holding the underlier and it's an index, they fall under 1256, and because they're trading options, especially like 0DTE, they get additional tax benefits. Whereas if they're just holding the synthetics, they have to distribute all the extra premiums. So good thing to notate.
Absolutely.
What's your take on Bitcoin?
Bitcoin.
Where are we going?
It's in such a trading range for the last couple of weeks, like 89 to 84, just back and forth. I mean, it's Bollinger Bands are starting to squeeze. It's going to move. Question is up or down. I'm bullish on Bitcoin, but it's just such a weird, different than any stock or ETF. It's got a mind of its own, and it's going to move big. I'm thinking to the upside, but it could go down, into the 70s or below. I mean, remember the high was at what, 126 it hit that in April and then it tanked. Mm-hmm. And then it went back up to like 125 in, what was it, September? Then it tanked. The low, I think, was November 21st. And it's just been bouncing up and down in that mid to upper 80s. It's hard to say. I'm bullish on it. But I can't, so I hear people saying 250 by end of year. I say no way. Of course, end of year is next week. I mean, I think 90 by end of year would be nice on Bitcoin.
Yeah.
But it's just hard to say. It's just not moving much. And all the indicators are just clamped right in that range. So it's just hard to say.
I think it keeps, I did a kind of a breakdown on this. It takes, depending on where you are, if you're residential or commercial, it takes right now between 84,000 and 87,000 to mine one Bitcoin. Yeah. So I think that's why it keeps bouncing off that range. Yep. I made that video a couple of weeks ago, months ago, actually, back when it was at like 106. It was trading. I said, it's going to fall down to range. That's when you want to stack, because come June, July, usually is when you start seeing the early adoption and the nice run up. It's usually 15 months pre the halvening cycle. To add to that, now if electricity goes up, say 3 or 6% annually, that cost to create one. Think of it like I think of it like a piece of artwork, like Picasso. The cost to create one also has to go up, and you kind of have to bake that into might be 3%. All right, so maybe maybe the value is 91,000 after you bake in the cost of electricity is kind of inflationary, like it's going to go up. The cost is going to go up. So maybe you bake that in, or the GPUs to mine them, the NVDA, like those stuff cost money. Yeah. Right. So that kind of has to get baked into the equation somewhere.
Right now it's pretty much at cost to mine. What happens if it goes to 75,000? Are people going to stop mining it because it costs more to mine one? And then the supply changes, and then it shoots up. Then they start mining again. I mean, it's crazy to watch it for sure.
Yeah, it's very meme-like. Like everything seems to be meme-like.
Yep.
I've become a fan of this term, leptokurtosis, which
I haven't heard that.
You haven't heard that? Okay, so leptokurtosis. So if you think of like the standard deviation, it kind of looks like a bell curve, is like 10% annually. Leptokurtosis is anything you look at now, whether it be Palantir, Robinhood, Walmart, gold, everything goes straight up and comes straight down. That's leptokurtosis, is these crazy, and then you have these little tail ends that wag the dog sort of thing. That's what leptokurtosis is, these massive deviations, 30, 40%. You're like, this wasn't on my bingo card.
Yeah. And I've like I said, I've watched the market for decades, not always in it. This year has been the weirdest year I've ever seen. Just so unpredictable. And it's crazy. I mean, the VIX is going down, but stuff's still going crazy. And then, but like Bitcoin is not. It's just sitting in that little range. But like gold and silver are just tearing it up. It's just weird.
Do you play call options or put options on the VIX?
On the VIX, no. I know you do because you mentioned it because it's low. So yeah, what are your thoughts on that? Like,
I'm waiting for it to snap back because when it does, the VIX normally trades between like 17 and 22. So
Yeah.
it's way low. So when it does snap back, it's going to be violent.
Yeah. And it always does. I mean, if you look at the history, it's up and down, up and down. It was at like what, 26 or 7 just in November,
Mm-hmm.
mid-November.
It's a
So
massive sell-off. Yep.
yeah.
And normally I'll place a call option on the VIX as a safety. No, that's cool. Who's your other than yourself? Who's your favorite YouTuber right now? Who do you like watching?
Well,
like, who do you go to for your news?
for my news,
Yeah,
I'm gonna go to YouTube for news.
No.
I do. Well, I listen to Retire on Dividends every morning for sure.
Yeah,
Getting
Rod's
ready
cool.
for work. It's part of my habit. I watch you a lot. I love the Financial Heat podcast with Matt and Pat, and you're on there sometimes.
Yep.
And then various guests. They're out of the box, which I like. It's not just standard, standard stuff. It's like UFOs, and I think he thinks kind of ahead of the game a little bit.
Yeah.
And so I like that one. I mean, you guys are my regulars. And then if I have time, something will pop up, I'll watch it. Yeah.
Do you ever jump on Spaces?
Yes. I Yield Max does every Wednesday with Wolf Financial at noon. I do listen to that. Sometimes I interact, sometimes I can't if I'm at work, but I do listen. Anytime there's a Spaces, I'm usually listening at least. There's some crazy ones that I don't, but like I love Wolf Financial, and they're on there all the time. Someone did one, I think it was Ambassador of Quan did a Spaces with Rec Shares, with Matt Holcomb and the Rec Shares. I like Rec Shares.
Yeah.
So yeah, I own the drones is from Rec Shares fund that I own, but their covered call ETFs are growth and income. So they're not as capped on the upside. They only, they do synthetics and then they sell calls on 50% of the synthetics. So they still have some room for upside. And if you look at their numbers, their yields are lower. I don't think they have 100%er, but they've got 50, 60, 70%ers and yield. And then total return on most of them is green. And they're all new. They're all from this year.
Well, how do you feel about some of these are like the yield boosts and whatnot, they're 120% plus they pay. How do you feel about that? Too much?
I think no, it is a lot. And a lot of people say too much. Mm-hmm. Can you hold some back to protect that NAV? The problem is they have to pay 90% because of RIC rules.
Yeah.
And they pay weekly. So when they pay 150% annualized, they can't recover that weekly every week unless the underlying really runs. But with yield boost, it's just put credit spreads. They're totally capped on the upside. I mean, if the underlying goes up, they don't make any more money. They don't do a synthetic with yield boost. It's just the premium from the credit spread. That's the income. And as long as it doesn't go down, the underlying, then they're safe. So
okay, I like the put credit spreads. I think those are great. Personally,
I do too.
But I will only do them on something that I see falls. I try to stick within the Bollinger Band range. If it's falling 61%, I'm doing as many put credit spreads as I can, especially if it hits negative gamma. So negative gamma, I was doing it on Iran like 2 weeks ago at 25, and then it just ran. And I'm like, all right, perfect. So maximum profit, but like you said, you have no upside. Like you just can't get the upside. Just like this is just income.
Yeah. So like Retire on Dividends he does this what he calls Roddy fund, where he does a poor man's covered call like a year out. Mm-hmm. buy call, sell put, like a synthetic. He sells calls on it and does put credit spreads. So he's protected on the downside, still capped on the upside, but not as much. And I still am trying to figure out how it works. But that's fun. That's fun to watch. And it's too advanced for me at this point. I like covered calls. I do iron butterflies, which is kind of, it's put credit spreads and call credit spreads. But you are capped up and down. It's just, pure income. So if you want something high IV that's going to pay the premium, but if it's high IV, it's going to move, and you don't want it to move. It's a neutral strategy. So,
well, for the call credit spreads, because I call this the wheel squared, where I'll do put credit spreads, because you're responsible for just the width between the two numbers, and then God forbid I do get assigned, I'll do a call credit spread, but I'll go in the money, so you get maximum premium, and then I'll do a buy call that's in the money, so you have intrinsic value, so you're already in profit. So I use the premium to buy the call, and then it's unlimited upside.
Okay.
So that's the way I found around it.
Okay. I gotta look into that.
Yeah.
Yeah. Okay.
I don't know. I think it works. The other thing I really like I said, the put credit spreads are great. If you can fall into that 61.8% from all-time highs. But what I'll do is I'll go, like right now I'm going 2028, 2027. And because the premiums are like 50%, right? Again, I'm looking for negative gamma. And usually it's all positive, but then you'll have like one benchmark that's negative. So I'm looking for negative gamma, 61.8% down from all-time highs. I'll go super far out. The premiums you collect are like 50%. So then I'll start buying either call options straight out, or I'll buy the actual underlier. So I actually have, it's almost like free, it's like free upside. I can't hear you. I think something cut out. No, it's like kind of, it's going in and out.
Hang on. We do.
There you are.
Okay.
That works.
It says noise removal is on. Maybe there's some background noise. I don't know.
What do you think of that? Is that something you could employ?
What's that? That strategy?
Doing like a put credit spread and either a call credit spread?
Absolutely. I like what I've been doing. It's pretty simple. Is just a wheel selling puts, and I like the 3x index funds, SOXL, TNA, TQQQ, because I don't think they'll go to zero. And you get assigned, you sell calls. I mean, the IV is always there because they're 3x.
Yeah.
And you're usually not stuck holding them forever like you are with a single stock. I did a wheel with a single stock years ago, and I ended up holding that thing for 11 months. And the IV had dropped so much in that time, I couldn't sell calls on it for anything. So I just ended up holding it. Eventually got back to my cost basis. I sold it, break even, but it took 11 months to do it. So single stocks, not a huge fan, but I do like the 3x index stuff because they should always have good IV and not tank on you. They still can.
So, which begs the question, if you can do this yourself, why bother holding dividends?
Because like I said, I own 25 of these. I can't do, and most of them are single stock, which I won't do myself. So it's just, park some money in there, collect the distributions, reinvest, if it makes sense to. I don't own all of them, and they do it for you. And yeah, they charge a big fee, but it's worked well. It's for lazy options traders,
How do you feel about that 1% fee? I know back in when Ulti, it's like a hot topic. When they launched, it was over 2% for their annual fee. How do you feel about that?
Mixed. I mean, it's as the person buying the fund, it's a lot. But if you look at how actively they're managed, I mean, they're trading multiple times an hour on all of these.
Mhm.
So, I mean, they're working. It's not like, like VU, where, they don't touch it every day and, much lower fee. So, mixed about it. I don't like to pay it, but I understand what it's doing.
And what about like dividend aristocrats? You got something like Coca-Cola or SCHD. Where does that fit?
I own none of those. And I think Dividend Kings, is that the one it's up 50? Dividend has grown every time for 50 years or something, or is that the aristocrats?
I think it's aristocrats.
Yeah. And if you look at some of them, their annual yield is less than 1%,
Mm-hmm.
but it's gone up for 50 straight years. What did it start at? 0.01. I mean, I like that, but the yield is still low on a lot of them. Some of them are great. Some are 14%. But yeah, I haven't. They're not degenerate enough for me.
So, but I mean, it's kind of people talk about that all the time, and they go, "Well, yeah, the yield went up 50%," but it's like, well, you went up from a half a penny to a penny, like, well, actually, it's a half a penny to 75 cents. It's not really
Yeah.
like it's not even noteworthy. I wouldn't get out of bed.
Right. Yeah, and that's how I feel.
Yeah.
You got to look deeper into it. If something paying 100% goes up 50%, that's something. But yeah, if it's a half a penny to three quarters of a penny, no.
All right, what's your take on return of capital? Good, bad?
Both.
I get mixed. Everyone has their own mixed.
Return of capital, I like for tax reasons. You're not charged a dividend uh, gain. And I know a lot of people say, well, it's just them giving your own money back. It's not return of principal. Some of these, house money. ROC's 100%. I've got, say, $1,000 in the fund. It's paid me $2,000 in distributions. So house money. So I like return of capital there just for tax reasons. The problem with it is some of them declare, when they make their declaration, they tell you this is 98% ROC. Those are estimates. And the problem I'm having now, this is my first year in these funds. I want to sell some this week for tax loss harvest. But you can't, return of capital goes towards the cost basis, which you don't know what that's going to be till you get the 1099 next year. And so I'm having trouble with, what do I sell? Am I going to get a capital gain if I sell one because it's lowered my cost basis so much? Even though, like I use Robinhood. They show you your pure cost basis, but not with ROC and not ROC and all that. So it's hard you can't estimate it because you don't know what they're going to tell the brokerage that it's going to be till you get the 1099. So I don't know, but I do overall like it for the tax reasons, as long as it's not return of principal, which I think is very different.
Okay. So something important to notate is in these funds, you actually can't have what's good is you can only go to zero return of capital. You can only go to zero. You'll never have a negative cost basis.
Right.
Which is kind of, I like negative cost basis because I do options. I actually do go negative cost basis. So that's, I don't know, one positive for me, I guess. Interesting. So one of the strategies we teach I run a Discord. It's called Return of Cash. Return on Cash, sorry. And one of the things we teach is, so say you want to, tax loss harvest, which I did personally this week. You'll find a similar fund, right? So say you're down, I don't know, $3,000, $4,000, whatever. You'll sell that. I don't know, maybe it's TSLL. Actually, I did this. I did TSLW from Round Hill. I had bought it back in October. I was wheeling TSLL all year because I've done it for like 2 years. I went I bought TSLW from Roundhill, the 120% weekly dividend pair. It it's done nothing but fall, which is okay. Paid out massive dividends, but as soon as I got it, I started selling covered calls on it. So I actually have a super negative cost basis on it. Made a ton of money, even though it's down. So then I captured the tax loss harvesting because I sold it last week, and I bought TSLL when it fell. So now I have upside. I captured the tax loss, but now I have upside.
How much tax loss? Because you don't know
For
what
that
the
one
rock
was it was like $1,500.
Okay.
So it wasn't. I know you can only get the 3,000. I know.
Yeah. But my question is, how much of the dividends that they paid were rock and lowered your cost basis? So when you sold it, are you closer to a capital gain than a capital loss?
Oh, I have a massive capital gain on it.
Okay.
But just position wise, personally, I think I'm like, I don't really like Tesla. I love Tesla as a holding.
Yeah.
I like what Elon's doing. But as far as if you look at the PE ratio of Tesla compared to the rest of the Mag 7, the PE ratio, the forward PE ratio is like over 300%.
Yeah.
The rest of the Mag 7s are like 27. And I'm like, all right, so Tesla either has to reverse, it has a forward split, or it's going to just come down. In a covered call fund, I don't want 100% downside exposure.
I understand. Yeah. That makes sense.
So I did the TSLL, to with an option. I did, I'm doing puts on it, super in the money. And I'm trying to think. I did 15 strike. It was trading at like 22. So a little bit of downside protection. Anything under 10, I'm a buyer on TSLL because like I always look for the implied volatility. It does not like being under 10. And I traded that one forever.
Yeah. That one doesn't like being under 10 and it doesn't like being over 22. So it's been in that range for a while.
I've noticed a lot of IV crush though. I think a lot of people are, I always use the word getting hip to, how dividends and options work. And so for a while, everyone was trading TSLL. And so they just had a ton of IV crush. The premiums just weren't there. Yeah. And you'll see that people move into different funds and they're like, it's just not worth the risk.
Yeah. And that's why I'm not crazy about any single stock tickers, whether it's 2X, single X, because that can happen. And then you're stuck holding it and you can't sell calls on it because there's no premium and you're just stuck holding it till it moves.
Would you ever consider if there was funds you wanted to get rid of? A bunch of members in my Discord were doing this. They were trying to get out of the yield max positions because they were just down, and so we started covered calling them all, and they all just got taken away. I'm like, get an extra premium if you're gonna sell it anyways. Covered call and take the extra premium, and they did.
No, that makes sense. I probably will do that. I haven't looked at covered calls on the yield max funds just because I didn't think the premium would be there. But if I want to get rid of them, yeah, why not? Even in the money calls, I won't. My best total returners, my two best are both yield max funds, the Palantir fund and the Tesla fund. I don't know about since inception, but I bought those in March, adding reinvesting distributions into those. I'm up like 50 some percent total return. If I sold them now, I'm up 50%, counting the distributions I've received. And I own a bunch more shares. So those I'm definitely keeping. A lot of them are dogs. And, some I bought, early on, I was just chasing the yield, buying the yield. Mm-hmm. And I'd say half of them are not keeping up with the yield. They're down more than they've paid. And those I'm certainly getting rid of. And, but some, have recovered nicely and they're still paying. So I love it. And I like YieldMax, has the target 25 funds now on Tesla, Strategy, and NVDA, where they just try to pay a 25% annualized yield. It helps the NAV. Mm-hmm. And those are all, I don't think the Strategy one's up, but the Tesla one's up pretty big, and it's only been out a month, and those are weeklies. So I'm impressed with those. I don't own them yet. But.
So would you rather one of those target 25 funds or the Palantir fund from YieldMax?
No, Palantir fund.
Palantir?
Yeah.
Okay.
That's paid more than 25%, and its NAV has gone up because Palantir's has been up.
But is it sustainable long term?
I'm still bullish on Palantir next year. So yes, for next year, I think so. If Palantir goes down 20, 30, 50%, no, it's going to go down 70, 80, 90%, the YieldMax fund.
Mm-hmm.
And the distributions will go down too.
And what's your take on like these, everyone's reverse splitting? What do you think? Is that just an accounting metric? As Jay said, it's really nothing to be concerned with?
For me, for the most part, it doesn't bother me. If it was an equity, like Tesla, doing a reverse split, that's a problem with the company.
Mm-hmm.
But these funds, because they pay massive, and they have to, they can't withhold anything to protect the NAV. So like Strategy's just been a dog. They're paying big. I think it's 80% yield on Misty is the YieldMax fund. Strategy's down 60%. They're in an awful place. They had to reverse split. Number one, for margin maintenance and to keep them optionable, keep them from being on the pink sheets. So I don't have a problem with it. Now, if it becomes a trend where they're doing it every 6 months, you're eventually diluted out. But they've done it twice with their Tesla fund, and I'm up on that. So I was only in for one of them, but they did it, I think in 2024, they did a reverse split. And, because Tesla, I like Tesla. When Elon and did the Doge thing with Trump, that killed Tesla. People were burning Teslas and selling the stock. So I'm bullish on Tesla. The reverse splits, something to keep an eye on, but as of now, I don't have a problem with it. I think it's more just a maintenance thing.
I'm always curious to get everyone's take on this. When the stock's down, and I don't know why more people don't do this, that's when you should be reinvesting. If you're reinvesting when it's at all-time highs, that just seems kind of silly. I would rather take some of that money in a reserve, maybe buy some gold or whatever, and you wait for it to fall again. But your true value is going to come when you're reinvesting when the stock's down. So if anything, like YieldMax being down or MicroStrategy being down so much would be now is when you'd want to reinvest, because that's where your compounded gains are going to come from.
Yeah, I don't reinvest on all of them. It just depends on where they're at, what they're paying, what the underlying's doing, and whether it's worth it to, I don't want a dollar cost average going up, because then my cost basis is even higher.
Mm-hmm.
But yeah, that's something to think about for sure.
Cool. Before we wrap up, if you were to go back and tell your younger self something, it's going to be a generally younger audience that watches this, most likely. What would it be? A kid just getting into this space. What would you tell them?
Everyone's different. It depends on your age, your goals. If you're 20 years old, you plan on working for 30 years, buy VU. Just dump money into VU. But everyone's different. I got to age 50, no retirement, Social Security if it's there, which won't pay my bills.
Yeah.
So you can't rely on that. So I started buying these high yield funds to make an income, and I'm making over $1,000 a month. I've got about 20 in, and I've got under 20 in. I'm making about 18 projected. What I've noticed is a lot of these go down, and price, of course, and in distributions. So I'm finding that middle point. That's when I bought the Curve Silver Fund because that's paying much lower, but it's going up.
Mm-hmm.
So 2026, I'm going to do a little more of that. I'm still putting in my own money every week because I can afford to, thankfully. And some of the high yield funds have been great. Palantir fund from YieldMax, Tesla fund from YieldMax. What else has been way up for me? Those are the main ones. So those I'll keep, and then just I'll reinvest in some, not others. I'm going to sell a bunch probably Monday for tax losses, and kind of go more half high yield, half total return, and more precious metals because, like you said, I don't have enough exposure there.
Do you have any Tap Alpha, the T SPY or the TDAC?
I do not, and I've been looking at it. I saw your interview with Cy.
Yeah.
I love those, and that's kind of what I'm kind of moving into. Is I still want the income, but I want something that'll grow in value as well. So if I do sell it in 5-10 years, I'll make some bank on that too.
What I like about Cy and of Howard Chan from Curve, both of them are trained engineers. They don't have a finance background.
Yeah, I like that.
So they're just intellectually honest. Like, this is what we're doing. We're going to put on some protective puts, put credit spreads. We're going to do call credit spreads when you get these crazy times in the VIX. We'll add them in there. We don't want to cap your upside. We also want to protect your downside. And it just seems it's intellectually honest.
Yeah, and I've in my videos I go through a spreadsheet that I keep. I have added Curve to that. I'm going to add Tap Alpha to that. I like Quantify funds. I don't own any, but I like, they're doing the 100% Bitcoin, 100% gold stacked, which I still don't understand it yet. I got to look into that. And then the NEOS funds, they're all I think they're all merging into that, where it's, high yield, but not 150%. And
yeah, I would agree. It seems like people have kind of come full circle and they're going more into I'm good with 15% if I can grow at 6-8% a year and not get, reverse split. I see a lot more of that.
Yeah. Those, I came in, I saw 100% yield, I'm all in. Pay me 100%. Didn't see the NAV erosion, which I will call it that. For a while, I was like, it's not eroded. And it follows the underlying. Something like Palantir, nothing but up. Palantir covered call fund, nothing but up, and paying big yield. But Palantir is going to come down at some point. How will it respond? Probably like Misty from YieldMax, same thing, But they do follow the underlying for the most part. The problem is they pay too much, but they have to. So they're, restricted. So that's why I like, something like the Tap Alpha, where they don't have to pay 90% of the income, and, still have some upside and some income. That's kind of where I'm going this year. Then, once I get the income to retire, I'm thinking 3 to 5 years, and I'm, still putting money in, then just go growth. Still income, but then reinvest into some growth stuff and see what happens. It's a journey for sure.
I really like, and you'll have to look into this, is have you looked into Mags or Chat from Roundhill?
Mags and Maggie, they're a covered call on Mags. Yep. Yes, I have. I don't own either one. And what was the other one? Chat, no. Is that Roundhill?
That's Roundhill as well. It's Mags with I think they added Palantir and don't quote me, they might have Oracle. They have a couple Hood. They have a couple extra. It's like
Mag 10
basically. Yeah, like Mag 10.
Okay.
So I trade a lot of options on those ones. Those are fun.
No, they don't do options on those. They just own the underlyings, correct? On Chat.
Yes.
Yeah.
Okay. Chat, they own the underlying. Mags, they own the underlying. Maggie is a covered call fund on Mags.
Right. Yeah.
But the expense ratio on Mags is 0.29%. MAGI is 1.29%.
Yeah.
So I'd rather just own MAGs.
And do
And
your own options.
if you do your own options, yeah, it's 300% greater returns than just holding MAGI.
Yeah.
It's massive.
Yeah. Yeah. I got to look into that.
They do
Sure.
weeklies. You can do weeklies on it, which is nice.
Yeah. I love weeklies. That's why I do the Soxel, TNA, TQQ. They, cause they're weekly and I just monthly, you gotta, I don't know. I like weeklies. It's set and forget. You're done in a week. You either own the shares, you do calls the next week, weekly calls,
Yeah,
or you sell more puts.
that's it. It doesn't have to be complicated. If people just did that, they would be well off.
Yeah.
That's cool. Thank you so much for coming on today. Where can people find you? Where can people find your information?
My YouTube is Dividend Degenerates, plural. I'm on X at Div Degenerates. And I'm on Facebook too, Dividend Degenerates. I'm not there a whole lot, but yeah. But YouTube is, I'm in every day. X, I'm in every day. So those are the two best places.
Yeah, I've watched a lot of your videos. They're great. The breakdowns you do with the spreadsheets, I like them.
I appreciate it.
No, that's cool. Thank you so much. Any final words?
No, let's make some money in 26 for sure.
Cool. Yeah, no, I'm looking
Let's do
forward to
this
it.
again. Let's
Yeah,
do this again.
we'll definitely do this again. I think you're coming on the financial heat, right?
I am January 8th.
January 8th. All right, so I'll
Yep.
see you in like 2 weeks or a week and a half.
Yeah, I'll be ready.
I think I'll be on that one too.
Yeah, hopefully Matt won't roast me too much, because he says covered call ETFs suck.
Yeah.
And I know what he means. I mean, the zero DTE is the big difference. The overnight exposure is what kills most of these. So I love what he's doing with the income blast, and I own both of those.
Yeah. Yeah, we there's a bunch that are coming out.
Yeah.
So I can't talk about them now,
Of course not.
unfortunately. And I know Tap Alpha is coming out with some new ones as well. So Rex shares and Tap Alpha are both they fall under so Total Capital actually manages they help them launch and stuff. They do their own trading, but so it's kind of interesting to see where everyone's going. I think put credit spreads might be the way though. I wouldn't be surprised if we see a lot of people moving into that.
And I like ULTI from Rex Shares.
Mm-hmm.
It's they do put credit spreads, call credit spreads, basically iron butterfly on big IV stocks, 20 to 30 of them. But if you look, they're high IV, but they're in a trading range. So, and they'll do the iron butterfly on that. And as long as it stays in that range, which some do, some don't, they make money. So I do like that. They will launch at the worst time, of course.
Do you play off Delta?
I do.
If you had to pick a strike, what's your high Delta, low Delta numbers?
25 Delta. I sell my puts at 25 Delta, and then if I'm in the shares, I sell my calls at 25 Delta. Because at that point, once I own the shares, I'm not desperate to get out of them. So 25 Delta calls till it gets called out. Usually it'll be above my cost basis, and I'm fine with that. And I made income each week along the way.
Cool. Thank you so much again for coming on today.
Thanks, Dan. Appreciate it, bud.
Yeah, we'll talk to you in like a week.
Yeah, we'll see you then.
All right, cool. Take care.
You too, bud.